Hello and welcome everyone to another market commentary session with StashAway. And of course, we have with us our CIO and Chief Investment Officer, Freddy Lim again.
Hey guys, how are you doing?
I'm good. How about yourself?
Same. Looking forward to coming back to the office.
Yes, we both get quite tired of looking at each other always in the same spot like this, right? It's always the same. Feels for people probably that we're just doing it all in one day or something. Anyways, it is another week, and another week has gone by, and markets have been literally kind of on fire last week, right? I think I think Nasdaq has been up all close to 6%, I think, last week or something like that, right? Or 5 point whatever. Definitely, we're seeing levels as of pre-COVID almost, right? So, with that being said, Freddy, just to throw it right at you. Can you give us a little bit of an update? Anything that's of interest that's coming up this week, or that you're looking at this week for listeners?
Right. As I said last week, I was concerned with maybe a resurge in the infection cases in the U.S. Due to the protests, and I think it has happened. So it doesn't seem to have done much to markets. Fortunately, but yes, that's rising infections post protest wave is quite natural. Two, markets sort of not doing much and waiting for tonight's Federal Reserve's meeting. I personally do not expect anything eventful to come out from the Fed. They have done so much, and what needs to be left to be done is to continue to monitor the situations of the economy. The Fed is probably going to go into more details about how they're going to find more ways to help small, medium enterprises, but that's not going to be the focus of the markets. That's fully priced in the $600 billion program. That tends not to attract a lot of attention from markets. So I really don't expect much market driver or volatility due to it tonight.
Yeah, thank you, Freddy, for that quick update, because I think we have a lot of and long questions that we received over the last week, right? That you and I both wanted to address today. So let's go right into them so that we can answer as many as possible. Let's go with the first one, which is kind of, I think, builds up on what you've just said as well, what we've been discussing the last couple of weeks since our reoptimization. It was from Wen Zhang, and he wrote in and said, COVID has disrupted the earnings of industries asymmetrically. While the large and tradable ETFs selected by StashAway offer good diversifications, these ETFs place funds in companies where earnings are also negatively affected by COVID, because they're tracking certain indexes where a bunch of companies are inside of. For StashAway, besides the shift out of Europe and the decreased exposure to US dollars, is there any way that StashAway mitigates portfolio's exposure to industries whose earnings growth potentially are permanently altered by COVID?
Yes, number one, I will first answer is that some industry will be quite, for a long time, are going to be affected for a while. Hospitality, restaurants, airlines. But at the same time, yet the market goes up recently for any of these things. So it's not as simple as just to look at post-COVID impact on the business, but it also is important to evaluate how aid and the stimulus is going to filter through to these companies. As I said earlier in the market update, we also need to analyze how the Fed is going to channel there are programs for small, medium enterprises as well. It is very difficult to just analyze this mountain of information. But fortunately, so far, the way we analyze it, for example, for XLY, which is consumer discretionary, actually Walmart is doing very well because they are equipped to take it offline, right? And Amazon has done very well, and two are equally big in terms of market share in XLY itself, right? They're nearly 40%. So in a way, when we look at the ETFs, we look at the component that's going to be affected more permanently. We also want to look at it versus how much of it is going to be gaining from a very different way of doing business. So in the case of XLY, it's fairly balanced because 48% of that ETFs is actually going to benefit from the post-COVID world, and the other part is probably not. But overall, the market is not going up for no reasons. So we have done those analysis, and I actually think that most of the funds that we have chosen, that since the last reoptimization, they are quite balanced in between the two. Performance has gone up, and I don't think the market is too dumb to recognize that. Other than that, you also know that we think that there are other factors at work. So the US dollar depreciation risk plus supply chain disruption potentially because of COVID, and supply chain disruption potentially because of also the US-China trade war. See, there's so many things to think about, not just the COVID, but in that sense, we have introduced China Innovations Fund into the portfolio precisely because of the risk of US dollar since dropping because of stimulus, 2, because of supply chain disruption to COVID, 3, supply chain disruptions to ongoing US-China trade war, right? So I think the last reoptimization has actually addressed a lot of those risks, but it's a systematic process, it's not a human process. We tend to leave it to the risk calculator of ERAA, right? I hope that answered the question somewhat. Weng Zheng, if you would like to deep dive further, please feel free to engage my customer engagement team, to reach out to me. We can actually take it offline and deep dive further.
Yeah, but I think that was a pretty good overview of an answer to his question, right? And I think we can go. The next question actually kind of tags on to the US dollar exposure side of things, right? So Tan Yong Boon was actually asking, I understand that as with the Fed's massive and rapid QE, there is bound to be a large surge in the supply of US dollar and hence a depreciation of the currency. So just what you just mentioned, right? Exactly yes. That reason. So the person saying in 2008, 2009, there were quite major fluctuations in the exchange rate with a strengthening US dollar at the start. And then over time, the US dollar fell against the Sing dollar, right? Should we expect something similar this time around? Is kind of what
yeah. Quickly on this, it's relative between two countries, and if you look at Singapore, the government aid is equivalent to about nearly around 20% of GDP, and for the US, if you look at the government side plus the Fed stimulus, the Fed stimulus is going to be multiplied by the velocity of M1 money, where so 2.3 trillion the Fed stimulus multiplied by 5.3 times in the money multiplier means that the Fed is printing about $12.5 trillion. So it's about printing 15.5 in total in the US. That's almost equivalent to nearly 8.8 months of GDP. Right? And versus Singapore, which is about 3 months of GDP. So the US is printing more dollar against Sing in this case. You can reasonably argue that it's likely to happen again, like a post-2008 situation where the US dollar can depreciate, and especially against Sing dollars. It's quite easy to tell. It's quite possible over the next 18 months, we can see a steady depreciation of dollar against Sing to the tune of 22.3 percentage point. If you believe that the March 2009 to September 2011 scenario happens again. But because this time we printed so much more, could the US dollar drop even more than that? That we wouldn't know, but the risk is always there, which is why we reoptimize the portfolio away from the US.
Yeah. No, thanks for that, Freddy. I think that clears up Tan Yong Boon's question for sure. So then let's actually, I think we do have a couple minutes, so let's wrap it up with one more question. Vasi is asking to both of us, any plans on adding another commodity? So basically saying, gold seems to be, at 7-year highs and unlikely to provide any further returns going forward here. Could you potentially even lose value, right? Over the next.
I thank you for the question, but I actually have a different take on gold's role in the portfolio. Looking at it on its own, who knows? Is not. Actually, there's still significant upside in gold for 4 reasons. Number one, the supply-demand first. 191,000 tons of gold has been mined. Only about 50,000 tons left in the ground. It's harder to reach them. It's costing 3 to 4 times more to reach them. So that's number one. Number two, from a geopolitical standpoint, if you look at central banks like China and even a lot of the national central banks of individual countries in Europe, They've been systematically buying gold every year, and the reason is related to geopolitical tension. If another Brexit happens, a country that leaves the euro, or when the euro break up, you need to reissue a new currencies. And when you're new to the international trade order, you need to have some sort of precious metal or natural resource as reserve to back your new paper. And until you gain confidence for a few years, then you can wean yourself away from asset-backed currency towards paper currencies again. So geopolitical risk tends to see systematic buying from central banks. Same thing with China. Since the US-China trade war initiated by Trump, the mistrust is massive, it's all-time high. That is not going to go away. In fact, may escalate into the elections. So there's many reasons I can argue for that. We can't just look at a price for historical prices for gold to say whether it's not going to make money anymore. But however, that's not how we look at it. We do not look at gold as a trade. We look at gold as an instrument in the portfolio that provide portfolio insurance, regardless of where it's valued. And since the market has gone back so much, and the more important the role of gold is now, in the sense that if we have another market corrections or crash, or a second wave of virus came back, or who knows what's going to happen to the world, and now valuation's gone back up so much, the risk is actually higher going forward for not having gold. Gold has proven itself during COVID, and every single market crashes that we've seen dating back to 1880 that balances a portfolio risk and create day one insurance. So we have it for a variety of reasons, not for trade. And the algorithm tend to curate it in a way that you still have return at the portfolio level. But the gold may be down, right, as a line item sometimes, right, in good times. But that's not how we look at it. We look at it at the whole portfolio level, whether we can mandate it to the risk level that you are choosing, right? So gold has a role regardless of that.
No, I think the diversification part is so underappreciated always, right? And they look at everything because just looking at returns is not always the right way to look at this here, especially in terms of gold, right? When it has that great diversification specifications built in as well. So no, that's really good. Let's wrap it up here, Freddy. I just want to quickly shout out the next few upcoming webinars that we have for everyone. In Singapore, we have one on the 18th of June. That's a Thursday. You can sign up for our webinar on how to plan for your retirement by going to one of the links here in the show notes below the video, or you can go to our website to sign for that up as well. In Malaysia, on the 17th of June, which is a Wednesday, we have an event on personal finance basics. Again, the link is in the show notes below. Otherwise, visit our website, Eventbrite, Facebook page, wherever else you can find StashAway. There will be one way or another to sign up for those two webinars. Again, thank you very much, Freddy, for your time. I think it was very helpful, and we'll be all with you again next week. Until then, have a great rest of your week. Goodbye. Bye-bye.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.